Quantum Cosmos presents Certified Financial Guardian, a seal of ethical selling. Privileged to bring you Pankaj Pathak. Pankaj joined Quantum Mutual Fund in August 2013 and at present is the fund manager of Quantum Dynamic Bond Fund and Quantum Liquid Fund. Pankaj has over a decade of experience in fixed income research and investments, and he also holds a postgraduate diploma in banking and finance from the National Institute of Bank Management, Pune, and he's a qualified chartered financial analyst. Pankaj, thanks for joining.
Thank you, Rounaq.
We'll discuss the credit risk in the Indian debt market, path to interest rates, and how to approach debt mutual funds now, particularly all debt instruments and mutual funds now. The RBI has reduced rates for 4 consecutive times this calendar year, cumulatively by 110 basis points. Right. And since the June 2019 policy, they have maintained an accommodative stance. There is a clamor for rate cut and in order to support growth. But will the RBI give in? Will it reduce rates? Will it honor the clamor for rate cuts?
So, there's definitely some room for further reduction in repo rate. Let's go back a little. For the last 3-4 years, if you see that actual inflation readings have surprised everybody.
Right.
For market and even the RBI.
Okay.
Every time we expected inflation to move higher the next year, but somehow it remained muted. Mm-hmm. So it seems that the disinflationary forces are much stronger than what we had anticipated. Mm-hmm. And that led to very high real rates. Means RBI has been very conservative in cutting rates because of that inflation risk. We are still anchored to that high inflation environment and kept very high real rates for very long time. Now we do need positive real rate, right? But there are also consequences when you keep it elevated for very long time, and that has actually hurt demand. Now with this context, if you look at the current scenario, the same thing. Currently, we don't see any major upside risk to inflation trajectory. If you look at the major factor, the food. Now, government is holding more than 3 times that required buffer in terms of their food grain. Right. When recent reports suggest they don't have now enough storage to buy the new crop. On the commodities, most of the commodities are falling because of that global slowdown, and then that slowdown is most likely to accelerate in coming few quarters. Right. So we can see further drop in many of the commodities, and the crude, which is a very heavy weight in our inflation and CAD and all other macro parameters. So again, crude prices have also softened. If you look at all these factors, we have enough disinflationary forces still driving on that inflation front. Correct. In this scenario, when you don't face much of inflation risk and at the same time your growth is slowing down, I think RBI has to pass on whatever room is available now. They have to take some aggressive move on monetary policy. So we do expect some interest rate cut in this policy. Now, they have deviated from the 25 basis points multiple, so it's become very difficult to guess what would be the quantum of cut. In this policy, it could be whatever 25, 40 or 50 basis points. But the real question would be whether they'll be ready to go below 5% repo and sustain there. Right. So that we need to see. But in my opinion, I think they need to go a little aggressive on the monetary front.
So aggressive, but would they do it staggered? Like if you say 40 basis, 20 basis, 20 basis, or would they do it direct 40 basis points?
I was expecting higher cut even in April and June. I was wrong. RBI was much more conservative than our estimate. But this time again, I think they are already running behind the curve. So that economic situation turned very sharply when we entered into 2019. Correct. If you remember that last year by October, people are expecting rate hike.
Right.
And by December, things have turned so sharply, and globally, it's not just India, globally, that we started expecting rate cut, and it materialized. After February, we had cut. But RBI was more gradual in nature while easing the monetary policy, whereas economic scenario turned very sharply.
Correct.
So I think they need to be a little aggressive in their approach while acting on rates.
Correct. So, but is there a fiscal room, because to reinvigorate economic growth, Nirmala Sitharaman slashed corporate rates,
Right.
and it will have an impact in some form, maybe 50 basis points, 75 basis point upward it will exert an upward pressure on fiscal deficit. So my question is, will this not have an impact on fiscal deficit? And given that, and the S&P is looking at it at this event as a credit negative development, that's what they said.
Right.
So how do you see bond yields, and would they have that fiscal room to reduce policy rates very aggressively now?
From the government side, whatever steps they have taken in last few months were mostly very long term. They'll have very long term kind of impact, and nothing have been done to revive the short term demand as such.
Right.
On the corporate tax, it does affect the fiscal deficit, but it's not inflationary. That thing we need to understand, that this widening in fiscal deficit is not inflationary. Rather, it can be disinflationary. Right?
Because there is no boost to consumption.
Right. So no boost to consumption, and maybe corporates can pass on some of the gains in terms of price cut. I don't think that should affect the monetary decision in any way. RBI can carry on that path because it's not like government is spending heavily and that is leading to fiscal deficit. Now coming to the fiscal path, see, even before that announcement, it was very unlikely to achieve that revenue target for what government has budgeted for this year. Reason being that overall growth has been much slower than what they were anticipating, and the tax collection, that rate of tax collection till for the last 4-5 months of this fiscal has not been that great.
Right.
So there was some shortfall even before the tax cut, and after the tax cut, definitely you got more problem for the tax revenue. Government's own estimate for this corporate tax cut suggests that there will be shortfall of close to 1.45 lakh crores.
Right.
That's turned out to be close to 0.7% of GDP.
Correct.
We cannot look at only one side. The other side is, first thing, they have got that fiscal bonanza from RBI in terms of that extra dividend. And secondly, on the expenditure side, this year government has budgeted an expenditure growth, revenue expenditure growth of more than 20%. If you look at the actual numbers.
Right.
I think they have enough headroom to cut on the expenditure, and provided they have already passed on some of the surplus to corporates for their spending, they can reduce their spending without compromising much.
Right.
We have to just wait and watch what's government intention on this part. There could be a chance where they reduce their spending to a certain extent.
Right. Because the front loading usually happens in the first half of the fiscal year.
Right. And this time they are actually behind the curve in their spending pattern because of elections and other stuff. So there could be some spending cut. Our estimate is that fiscal breach would be maybe limited to 30 to 40 basis points. Maybe we can see fiscal deficit widening to 3.7% rather than 3.3 what government is estimating. And in that case, that market borrowing can increase by around 40,000-50,000 crores. In this calendar, the second half calendar, what they announced just 2-3 days back, they have not increased the market borrowing as of now. And that secretary, that economic affairs secretary, he stressed on that government will maintain its fiscal deficit target. But it's very difficult to believe as of now. Means they cannot cut that expenditure by so much of amount. But still, for the 50,000 crore additional borrowing. Now coming to the GSEC part, that interest rate part, if you look at the term premium, that is spread of 10-year bond over repo rate or the 30-year bond over repo rate or the entire curve, I think that term premiums are at a levels where they are discounting much of the fiscal breach as of now. We'll see some impact, but it will not be that severe.
Okay.
We have to just wait and watch what other things they announce in near future. There are media reports about government will raise more from disinvestment. They have already given some list of. But that's the usual trend. Means every year that major disinvestment happened in the second half of the year. So that I think is the same thing for every year.
Do you think the market environment is so conducive for disinvestments right now?
It depends on how they proceed. When this government came into power, the first year we were kind of bullish on PSUs. Means I'm talking from our from fiscal point of view, not from the equity market. That government will go for privatization kind of mode to raise money from disinvestment. But they actually compromised on that part. They call it a strategic disinvestment and make it ETF route and started selling. That was actually value destroyer. They lost all the PSUs. They lost value. But this time, I think they have listed few companies. Now I think there are 4 where they're going for selling entire government equity to some private sector. If they look at this route, I think there would be enough taker in market who are interested in Indian market, catering to Indian market rather than buying a small portion of a public sector company. So, but still that target is very ambitious. They have already factored in 1 lakh crore in budget, almost 1,10,000 crores. They want to increase it. So it can be challenging. We have to wait and watch. And other than that, they have also listed some of the assets, government assets that they want to monetize. The gas pipeline, railway network and various other things, that MTNL towers. So we have to just wait and watch and see how much they can do on this front.
What is your view about the loan mailers and offering repo-linked loans without specified income criteria? Would that not add to the NPA problems and therefore the credit risk?
Actually, I'm very skeptical about this entire process. When I look at the current slowdown, it's not a normal situation, right? And in time like this, you have to take some extraordinary measures. I think this is one of them. We have to be very careful when we take a top-down approach on credit. It should be bottom-up. History suggests that this top-down approach usually lead to poor credit standards and cause some other problem later on.
And this seems to be like a desperate measure to revive growth.
So I think it has to do more with that strain in financial system, because despite all that liquidity infusion by RBI and other stuff, there are some lack of lenders in market. That means all the financial system is very, very risk averse as of now. They don't want to take that risk. And maybe government is trying through public sector entities to boost that demand. So see, it can be risky, but it's kind of experiment. We have to wait and watch, but definitely they need to be very careful on this aspect.
So as a portfolio manager, managing the fund manager of Quantum Dynamic Bond Fund, how are you approaching portfolio construction in these challenging times? And typically, what is the average maturity you're looking at, the kind of issuers? What is the kind of process which you're following so that special care is taken to safeguard all these credit risk events, to safeguard from these credit risk events?
First thing, on the Quantum Dynamic Bond Fund, it's a kind of all-weather fund. So we have 2 risks to manage in any bond fund, and this is one of them. Now the credit risk and the interest rate risk. Credit risk, in case of Quantum Dynamic Bond Fund, the mandate is such that we invest only in government securities and public sector enterprises, AAA PSUs and government. We contain the credit risk to minimal levels. We do not take credit risk in case of quantum dynamic bond fund. So we are kind of insulated in this entire debt crisis situation. But we do take very high interest rate risk depending on the market situation.
Correct.
So there could be times when we take very low interest rate risk, and there could time like even this where we increase the interest rate risk in the portfolio
Right.
by changing the maturity profile of the fund. So as we all know that longer maturity papers are more sensitive to interest rate changes. Their prices are more sensitive to interest rate changes, and if interest rates move up, their prices fall. As I mentioned earlier that we are kind of positive on bond market at this juncture because we see enough room for reduction in policy repo rate, and that can have some positive effect on bond yields, means interest yields can fall. So in dynamic bond fund we are positioned in mostly in the long duration, long maturity papers, which tend to benefit more when interest rate fall. But this kind of tactical call means we are not secular bull as of now because we have already seen much of the easing. There could be some more. We are continuously reading what RBI want to deliver.
Right.
So they have scope, but many times they don't deliver that much.
Right.
So we'll get more sense as things progress. But it's kind of tactical position where we are running very high duration as of now. It can be lower later on. So that's kind of all where on the credit front we are not taking, so kind of insulated, and on the interest rate front we are positioned for a rally now.
Okay. Indian economy strives to be a $5 trillion economy by 2024. We are around USD 2.7 trillion right now. What has stopped the growth of the Indian debt market? I mean, are these debt crises so serious that it will really hinder the growth of our economy and we strive to be a $5 trillion economy?
See, in short term, we can definitely have some negative impact from this debt crisis. But over the period, these corrections, I will not call it as a crisis in this context. Rather, it's a kind of correction. So why? If you look at, just go back a little. By late 2016, near the demonetization and post the demonetization, most of the banks were reducing their fixed deposit rates. And if you look at the wealth distribution or the financial assets of Indian household, we are major investor into fixed deposits.
Right.
So as the deposit rates came down, people started looking at alternatives because the return expectations remain at those levels. And there is an anomaly that we don't look at the real rates when we invest. We rather look at the nominal levels.
Correct.
So even 6% FD rate is more rewarding now than that 8% in 2011.
Right.
Because that time you had an inflation of more than 10%, but now inflation is below 4. So, but anyways, so expectation was anchored to that high rates, and that led to very means that mutual funds, debt mutual funds, became very attractive product that time, and many of the investors actually came into products which has a short maturity, means most of the advisors even advising products which has a short maturity profile, because RBI was almost close to ending their interest rate easing cycle, and in February they changed the stance, and that triggered a big sell-off in duration funds.
Right.
And that time people moved to credit fund, and that created a kind of competition for yield. So that hunt for yield actually led to very high risk taking. So there was a time of exuberance. All the companies, even with a weaker repayment capability or credit quality, were getting money at very cheap rate. So there was an exuberance, and this was a correction, what we have seen in last 1 year, where you've seen that things have stopped, that entire funding of those debt.
You're right, because there were several defaults, delay in interest payments on several NCDs, and several heavyweights, and highly rated papers were also downgraded by rating agencies.
Right.
Now, in such a scenario, how do you convince a mutual fund investor to invest in debt mutual funds with respect to his asset allocation? Because debt is an important part of the asset allocation.
Right.
So how do you convince your investors? Because they seem to be totally risk averse, as you mentioned, with the kind of environment which we are seeing. There is a lot of risk averseness which has been set in now.
So as I mentioned, you always see these kind of cycle. This is one cycle where people came into into debt mutual fund with a risk return expectation, or their risk return expectation remain anchored to FDs.
Right.
They're not looking at the risk in those products.
Correct.
So if you follow Quantum for last many years, we have been cautioning against this risk. And we always said that credit risk can be contagious.
Right.
So it won't be limited to one entity. So even if one entity default, there would be another long list which can go into some problem. So this is a realization where investors first have felt that even they can see a negative return or credit default in their very short maturity or short-term instruments, debt instruments, where like liquid fund or short-term bond fund or low-duration fund. But in long term, these things are actually good for the bond market and even for the investors. Why? See, what has happened after all that fiasco? SEBI came into forefront. They started tightening the regulation. On the mutual fund, I hope many of them have built their internal checks and balances on and become more prudent. They should have become more prudent on evaluating credit. So this is a process.
SEBI has defined the risk management measures, defined the risk management measures so that the mutual fund houses take the right action there and then. But you think this kind of crisis can be handled because even liquid funds have given negative returns. IL&FS is a classic example. So you think SEBI has done everything proactively at the right time and the course correction is set in now?
This is an ongoing process. They have to get a feedback from the so they always get that feedback and try to implement. That's how things work. But they have made a significant progress in last 1 year after that IL&FS fiasco.
Absolutely.
And as far as the liquid fund, actually, even we have wrote to SEBI many times where we recommended that the product is positioned in a way that this is the safest thing, and you can keep your saving bank money in liquid funds. So the portfolio should be constructed in that way only. You cannot take very high risk to show higher return on liquid fund. And same thing we always advise to investors. When you invest in liquid funds, you park your short-term money in liquid fund or contingency fund, don't just look at returns. This is the last thing to do. Because the difference in the top and the bottom is not that great. You're not getting compensated for the additional risk. So always go with the safety and liquidity first, and then only return. So I think both the parties have to change the attitude. Now SEBI has tightened the regulation. Investors should also be a little prudent while they choose these funds, because that 10-20 basis points will not make that much of difference in their wealth.
Right. So between liquid funds, overnight funds and short-term fixed deposits, what would you recommend for someone who's looking to park his money for the short term?
I think I would be indifferent between all the three. These three are kind of equal options they can choose. I think in fixed deposit you have some lock-in. Before that we could not take, whereas in liquid and overnight,
so he could manage his liquidity conditions and accordingly invest.
Right. So but be careful about the credit risk. See, I always say that credit risk is more dangerous form of risk in debt products. And even the credit risk fund should not be treated as a usual fixed income mutual fund. There is something different. Why? Because in case of interest rate, you see a lot of volatility in your mutual fund NAV. If you hold for a longer time frame, your returns tend to normalize. Right? And we always advise investors to choose a fund which has a whole maturity or the duration, portfolio maturity or duration lower than your holding period. So if you're buying for 3 years, buy a fund which has a portfolio maturity of less than 3 years.
Right.
Your returns tend to normalize during that period. That interest rate risk you can manage. But in case of credit risk, things are very different, because then investors' behavior come into play.
Correct.
And we don't have very liquid credit market in India. Now, what has happened after IL&F is defaulted? Investors rush to withdraw their money from all these debt mutual funds which were exposed. Now, in a scenario when a company has defaulted, you will not be able to sell all other these kind of assets, right? What will you do to meet that redemption? You sell all the quality assets.
Right.
That's the only alternative. So remaining investors will get exposed to much riskier portfolio then.
Right.
So holding for longer time frame may not actually resolve your problem. It can give you more problems inside. So in this way, I think that credit risk is very dangerous, and especially in funds where you are investing for very short period of time, be very very careful in looking at the credit risk. Look at the portfolio yield, how much portfolio yield the fund is offering. If it's very high, means.
Do you think we are in the last leg of a rate cut cycle, and should investors be risk averse, and what are the options for senior citizens, because they are looking to park money in bank fixed deposits, more so in UCBs, urban cooperative banks, but even they are defaulting. Small saving schemes are an option, but again the interest rates have again fallen. So what is an option, and where do you see interest rates heading now? Are we in the last leg?
I think we are very close to the end of the rate cutting cycle. There could be some more, but it will totally depend on how economic growth play out in coming quarters. For the senior citizens, actually bank FD rate can come down because they have not passed on to that extent. For them, I think first thing, don't just look at the absolute return, that nominal return. If you adjust for inflation, they are still getting compensated in FDs. But I think that real problem for them is life expectancy now. Means
so
you
the
cannot,
rate of return is also not very great in that case.
So you cannot maintain that lifestyle if you live very long, live for very long time. So maybe they need to take a little bit of exposure in maybe equities, or even we have a fund, that multi-asset, quantum multi-asset fund. So that combines a little bit of
and in case of a debt mutual fund, where they should invest?
First thing, we need to understand that they don't have much of risk appetite. And when I look at investment, I always factor in that behavioral aspect, whether investor can bear that volatility. So in case of debt mutual fund, even if they have very long time frame, means if you are still 65 kind of age and you are expected to live maybe now in current scenario to 80 or 85, still you have a very reasonable time frame. But when they look at that volatility or the return in their portfolio, they tend to react immediately because they are so worried about that corpus. They don't have maybe a continuous stream of income.
And they're more comfortable investing in fixed deposits.
So they are more comfortable investing in fixed deposit. Maybe they can look at funds which have a shorter maturity profile, the short-term fund or this kind of fund, and maybe hold for longer time frame. And if they fall into higher tax bracket, maybe debt mutual funds can become attractive, because that tax arbitrage is post-tax returns in debt mutual funds are probably better than fixed deposit do. Apart from that, as I mentioned, they have to be really concerned about that life expectancy thing, whether they are providing for that.
Correct.
So a little bit of equity exposure can actually help them.
My last question. Which are the 3 books you would recommend to our viewers who are IFAs and investors where they can gain better understanding to invest in debt mutual funds and fixed income instruments in general?
See, I read a lot, but most of my readings are very random. I don't read a lot of investment books as such. But I've been very fascinated about this, we can call it behavior finance, where just investing behavior of investors and all the business cycle or the economic cycles. I found 2 very interesting books on these 2 subjects. One is The Little Book of Behavioral Investing by James Monitor, who is a asset allocator in GMO. So that gives a very interesting perspective about how investors behave and what mistakes we do. That's more important to know what mistakes we do while investing than what goes right.
And we can learn from our mistakes.
Right. And the other one is that navigating through that big debt crisis. That last year only Ray Dalio released this book. That Ray Dalio is founder of Bridgewater Capital. Even that book has given a very interesting perspective about that history of money and economy and debt situation. So I find these 2 books very interesting, and I think it can add some perspective.
Thank you, Pankaj, for your valuable time and valuable insight. I'm sure the fraternity will benefit from your use. Thank you. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.